Yeah, okay. So anyway, good morning. Thank you everybody for joining the webinar this morning, Demystify Financial Statements. And this webinar is basically to teach you how to read and understand your company's financial statement. So a little bit of housekeeping. My name is Beth Bockenhauer. I'm a CPA here in Redlands, California. Here is my email address, so if you have any questions after the webinar, you can definitely email me. You can also go to my website and follow my blog. Also, you can go to my website to click on the social media button to follow me on Twitter or like me on Facebook. The objective of this webinar today is for you to take away and implement at least one thing that will make you a better manager and a decision maker using your company's financial statement. So I'm hoping that you take at least one thing away and that you can, from this webinar, actually transform numbers to knowledge to help you succeed in your business. So let's get started here. The first thing we're going to cover is basic reporting on financial statements, and that's cash basis financial statements or accrual basis financial statements. If you're using QuickBooks, you can choose to run cash basis or accrual basis financial statements. And really what the difference is here is if you're a cash basis reporter and you're running your financial statements on cash, your financial statements will reflect in the income portion of your profit and loss, the sales when you actually receive cash, and the expense portion on your financial statements will actually post the expenses when you actually pay cash for those expenses. And a good example of a cash basis reporter would be a hairstylist salon, where your hairstylist actually doesn't give you terms to pay for your haircut. They actually say, hey, here's what you owe me, you go ahead and you pay cash for that. So that would be an example of a cash basis reporter. Now, if we have accrual-based financial statements, we are actually offering terms to our clients, such as a doctor or an office such as myself, or you will be using accounts payable, meaning that you're incurring your expenses and you're posting them to accounts payable, but you haven't paid for them. So the expenses will post to your profit and loss even though you have not paid cash for them. And your sales will post to your profit and loss on the income portion when you enter the invoice. And here is an example. I'll show you the difference between what a cash report would look like and an accrual report. These are exactly the same financial statements, except one is cash and one is accrual. And this is Larry's Landscaping, and Larry is a sample company taken out of QuickBooks. And we can see here that this is cash basis reporting. And we can see here that Larry, for the year of 2015, I know that hasn't happened yet, but that's the way the sample company works. So Larry, in 2015, talk about projecting. We have total income of $69,000. And then we have cost of goods sold for $110,000. And for the year of 2015, Larry actually has a loss greater than $100,000 on a cash basis. So if we look at the accrual basis report, once again, the same exact financial statement, we're going to notice a difference. And that's because Larry has posted his income on an accrual basis, meaning he hasn't collected it, but he's earned it. And you can see here that Larry's sales have sizably increased. Now we have $202,000. We have a little slight difference in the cost of goods sold. And then if we cruise down to the bottom of the profit and loss, we actually see that now Larry has a profit on an accrual basis. So just a little bit on the tax side, you can be an accrual-based reporter and file cash basis tax returns. And this is just a little game that we play in the tax world because we don't ever really want to pay taxes on money we've never received. So you can still be accrual for reporting in-house and doing your management reports, but can still file a cash basis tax return if you meet the requirements. So we're going to jump right in here and we're going to talk about the profit and loss. And the profit and loss actually has I broke it down into 4 sections. And we're going to cover the first 2 sections here in the next few slides. And the first 2 sections are income and the cost of goods sold. And income is simply the generation of revenues. This is how you make money doing what you love, running your business. This isn't the rebates that you receive on your credit card. This isn't the income or the money that the shareholder or the owner infused into the business to start the business. It is basically the generation of revenues, you going out there and hitting the bricks and doing your job, or your employees doing the job. And then the next portion of the profit and loss is what we call the cost of goods sold. And these costs, the cost of goods sold, are directly related to the generation of revenue. You wouldn't have these costs if you didn't have any income. So what kind of costs are cost of goods sold? And direct labor. So these are the guys out in the field, or the gals out in the field actually hitting the bricks and doing the work. We have direct costs, and those are known as, we call them brick and mortar in our industry. Those are the actual costs that are required to actually go out and generate the revenue. We have retail item costs if we are actually a retail shop. We have costs to construct, and this doesn't have to be a home or a building. This can just be cost to construct anything that you're building. It could be machinery, it can be an auto body shop, but the cost to actually construct, the direct costs that are related to the construction, and the cost to provide this service. We may be using a subcontractor to provide this service that we're selling. So it's all these types of expenses that are directly related to us doing our job. And these are also known as variable costs because they actually are directly related to the revenue. And as revenues go up, these costs should go up. When revenues go down, these costs will go down. So here's a nice visual of the income and the cost of goods sold portion of the income statement or the profit and loss. And we have income minus cost of goods sold equals gross profit. And then what we have here is we can see our income is $204,109. And we can see that our cost of goods sold here is $106,000 and change, and that gives us a gross profit of $98,000. So for us hitting the bricks and doing what we do, our profit on that is $98,000, just over $98,000, or it also can be referred to as a gross profit percentage, which would be 48%. And also, you may have heard the term out there, margin. When we hear people say, oh, my margin's this, that also is interchangeable with the word gross profit. So this kind of gives you a visual, and we can see here that we have it expressed as a percentage of income that would give us the gross profit percentage. On the next slide, we'll actually talk about how this is calculated. And our gross profit is simply, as we've already seen here, is our sales price minus our costs. And then to get to our gross profit percentage, we actually take the gross profit calculation, sales minus costs, and then we divide it by the sales price. We actually will have a demonstration down here below on the bottom of the slide here. And I just wanted to go over, if you don't understand this concept, that's fine, but I just at least want you to walk away knowing that there is a difference between markup and gross profit, or markup and margin. There is a difference. And we have a calculation here of what markup is. So you'll hear people say, well, what's the markup of that? That does not mean what your gross profit is. It's simply the markup. And our markup is actually cost times our markup percentage. So in this example here that I have on the slide, you see this right here, I have my cost of $100 times my markup of 15%, which means my markup is $15. So the sales price equals $115. So once again, markup and margin are not the same, and the above example has a markup of 15%. However, the gross profit in this example is 13%. And we'll go through the calculation, gross profit divided by sales price. So our sales price here is $115. We have cost of $100. Our gross profit is $15. Now if I go through the calculation, the next step, I divide the $15 by the $115, and I actually have a gross profit of 13%. just always remember margin will actually be higher than gross profit just because of the mathematics of it. And here's another visual. We have inventory items here for Larry's Landscaping. We have the cost. This column is cost. This column here is our actual revenue. Then what we have here is the difference. Basically, revenue subtracted from cost is our gross profit. Then we have our gross profit percentage using the formula, the calculation that we showed on the previous slide. And then here is our markup. So if we look at sprinkler heads, we have cost of $686. We have revenue of $915. We have a gross profit of $229, which calculates out to a gross profit percentage or a margin of 25%. And then we have a markup here of 33.39%. So that gives you a better visual of the difference between and how to calculate gross profit, get to our percentage, and get to our markup. And actually, this spreadsheet, this portion was actually just downloaded into Excel from QuickBooks. So if you are using the item list in QuickBooks, you would be able to run these types of reports. So moving on, how do we analyze our gross profit? Well, the gross profit is actually an indicator of a company's ability to cover direct costs and have profits remaining to cover their overhead costs or their fixed costs, which we'll discuss here in a few minutes. And gross profit tells the reader of the financial statement how much gross profit every dollar of revenue a company is earning. And here is a really good visual of that last statement, which is kind of hard to understand. So once again, we have our condensed profit and loss, our income and our cost of goods sold. And once again, we have income of $204,000. And this income will always be 100% because this column is a percentage of income. And we can see here that landscaping services makes up the highest percentage of our total income. Our direct labor cost takes up 48.26% of our sales. Our cost of goods sold, our direct costs, take up 3.7% of our sales. And our total cost of goods is 51.96% of sales. Basically what this means is that it costs 52 cents to generate $1 of revenue. And then here is our gross profit of $98,000, and this means that I get to keep 48 cents, a little bit more than 48 cents for every dollar that I generate in revenue. So a high gross profit indicates that a company has the potential for an overall profit as long as the company keeps its overhead costs in control. So how can you increase your gross profit? Well, one way to increase your gross profit is to cut costs, and that's obviously, it's very obvious, and that's built on vendor relationships. So are you utilizing your discounts that are offered? Can you ask your vendors for discounts if you pay in a timely fashion? Do you go and shop around for the discounts? Do you look for different vendor relationships that may give you a cheaper price for the same material or the same service? Another one that is very important is perfecting processes. And what I mean by that, do your employees know and do you know how to actually efficiently run your office and and I shouldn't say run your office, but run the work that needs to be done? Do the employees have a written procedure that they can follow? Has it been tested? Have the kinks been worked out? And it's just, it expedites the process and it's efficient. And it can be right down to are you using the right people for the job? It could be are you using the right tools, the right software? That's perfecting processes. The next thing is, are you using job budgets to analyze to the actual expenses? And job budgets are also known as estimates. So for an example here, everything in my office has a budget. My employees know how long a project is supposed to take them. I use that budget in my pricing model when I price out and I give the client an estimate. And then at the end of the project, we actually go back and analyze how long did it take you to do this project compared to the amount of hours that I actually budgeted. And I look for the variances, because the variances, if they're way variant, could mean that I have broken processes. I may not have trained my employee correctly. I may not have the right software, or maybe I just did not understand the scope of the project. So having budgets are actually very important. if you're in that type of business. We can analyze sales prices. Are we quantity or quality? Do we need to sell more to make a good gross profit, or are we offering quality and we need to increase our prices? Is the company absorbing costs that can be passed on to the customer? And one example of this, and I'll use my business as an example, is I do a lot of scanning in my office. People bring in their documents and I scan. And I pay somebody to come in and do the scanning. And I started to realize that I did not put the scanning in my pricing model when I charge for tax returns or when I'm doing any other type of project that has heavy paper that I need to get into my system. So I started to look at this, and now I can give my clients a service menu of options. They either can scan for themselves and provide me the documents electronically, or they can pay me to scan for them, or they can use a third party called Shoebox or a company similar and get their documents scanned. So this is just a way for you to analyze, are there costs that you're absorbing that can be passed on to your clients? And then just a question I want you all to ponder. What happens if you increase gross profit by $100 for 12 clients, or $100 by 12 retail items on a monthly basis? So if we did increase 12 items, retail items that we were selling with a gross profit that realized a gross profit of $100, or I increased my gross profit by $100 to my clients, I would recognize an extra $1,200 a month, which would end up calculating out to be $14,400 in gross profit, extra gross profit that I would have in the year to go towards paying my overhead expenses and possibly be realized in profits in the bottom line. So the third portion of the profit and loss is actually my indirect costs or my overhead costs. And these are the support costs. And unlike cost of goods sold, where I'm not going to incur those costs if I have revenue, don't have revenue. These costs you're going to have if you don't have revenue. So we want to monitor these costs very closely. And they consist of admin support, office expenses, insurance, rent, utilities, the internet, and professional support. And these costs are known as fixed costs. And that's because they really don't change as revenue goes up and down, okay? So as mentioned before, that overhead costs are known as fixed costs. And one way of really managing overhead costs is creating a budget. And the budget should be created annually, and it should determine how much gross profit needs to be generated. So if we're starting from the bottom up, and what I mean is, I'm going to calculate out how much it's going to cost me just to run my business, not if I don't have any revenue. How much is my rent going to cost? How much is the software going to cost that I need? How much are the desks and the software as a service that I need, or the dues and subscriptions I need? How much is it going to cost me to just run my business? And when I get that number, then I need to ask myself, well, how much gross profit do I need to even break even? So we can back into our sales number this way. But a budget is actually a really great way to analyze costs on a monthly basis and put in some cost controls. The one thing when I notice clients doing budgeting is that they seem to not budget for conferences and training and development costs. And you also need to consider increasing costs if you are on a growth pattern, because these costs, even though they're not directly related to revenue, they would increase if you are on a large growth spurt. So you would need to consider that as well. Once again, overhead costs can be expressed as a percentage of income, and this helps you quickly determine the company's largest overhead expenses. And here is a visual for you of what I'm speaking about here. Here's the income and the cost of goods sold side that we were looking at before, but here's our overhead expense side. And as discussed as a percentage of income, for an example, payroll, my staff payroll to support my operations takes up almost 23% of my income. Okay, so I can go through here, if I'm expressing my profit and loss as a percentage of income, I can go through and quickly see what are my largest expenses as comparable to income. And here I have payroll, I have my insurance is high, and then my occupancy costs are pretty high. And what I mean by that is my rent and my utilities to actually maintain my building. And those are my three largest, my occupancy costs, my payroll, which is usually your highest, excuse me, and then my insurance costs. So that's just a visual, and if you're using QuickBooks, you can actually modify the report and choose to run your reports as a percentage of income. I also have been reminded here that if you have any questions, you can press the red arrow on the right-hand corner. So that's if you have questions, you can go ahead and do that process. Okay, so this is obvious. Uncontrolled overhead expenses can actually be a demise of the company. And when we're actually reviewing our overhead expenses, we want to ask ourselves questions: what expenses provide a return and what expenses provide no return? So an expense that would actually provide a return might be training for your staff and yourself to increase expertise in your field so you can raise your rates. It could be designing something in your office, a process that may cost you a little bit of investment to get it designed, but the process expedites and provides better customer service. What expenses provide no return? That could be your office building is way too big for you, and we have unutilized space. We have to pay and heat that. We have to pay rent on it, but we're not getting the return because we're not utilizing the entire space. And that could be true for a retail store or any sort of professional business as well. And expenses to be aware of are interest, officer wages. We just talked about rent and utilities, office expenses, and insurance. Interest could be an indication on your P&L. If your interest is very high, you're carrying a lot of debt. Officer wage, something to really note because sometimes your business just cannot afford your lifestyle. So we need to monitor that. Office expenses, they can go a little array. People don't actually monitor how many times Office Depot gets hit. And then we could be overinsured. We want to have a good relationship with our insurance broker to make sure that we have the proper insurance. And actually all of them you should be aware of while you're spending that money. And then the fourth portion that we have on our profit and loss is our net income. And the calculation for that is revenues minus cost of goods sold equals overhead. And our net income, or also known as our operating profit, shows the efficiency of a company controlling its costs and expenses associated with the business operations. Basically a fancy term for revenue minus cost. And we're going to just show you a little visual here of what the net income would look like on a profit and loss. So once again, here's our income portion. Here's our cost of goods sold. Here is our gross profit. Here are all our overhead expenses, which total down here, $60,000. We subtract that. We got a little bit of extra miscellaneous income. This could be the rebates from our credit card, or interest income from our bank if we're so lucky. And then we have our bottom line, our actual net income off of our profit and loss. And once again, our net income can be expressed as a percentage of sales. And for each dollar of revenue earned, this is what, excuse me, I want to backtrack here. So it can be expressed as a percentage of sales. And in this case, our net income is 16.8%. And what this basically means is that for every dollar in revenue, I get to retain 17 cents. So that may not seem like a lot, but depending, in this case, that means that I get to retain or keep in profits $34,294. So that's basically, if we run our profit and loss based off on a percentage basis, we get to see how much it costs, how much we get to keep on so this, in this case, it would be 17 cents on each dollar of revenue earned. So on that note, we're going to move over to the next financial statement. And actually, this is the financial statement. It's called the balance sheet. It is the financial statement that I would be honest with you that most people don't understand and they don't review. And I'm going to mention this again, but I'll mention it now. You cannot manage your business just by looking at your profit and loss and looking at profit. And if you have a loss or if you have a profit, you have to manage from the whole picture, and that includes your balance sheet. Your balance sheet actually offers more history because it's cumulative. And what I mean by that, it actually shows a picture from when you began the business to where you're at, where a profit and loss actually closes down at year end. So at the end of your operating cycle, if it's a calendar year, your P&L will then close down. We'll discuss about that. And on January 1st, it will start all fresh and new with zero balances. So the balance sheet will not close out at 12/31. It's actually just a constant running cumulative history of your business. The balance sheet actually consists of 3 sections. One is called the asset section, and this is the section that you own. These are the assets that you own. And then from the asset section, we have current assets, and these would be your most liquid assets, your cash, your AR, your inventory. And then we have long-term assets, and these have a useful life greater than a year. Vehicles, computers, buildings, investments that you may have in other businesses, and any long-term receivables, meaning somebody owes you money and you're not going to collect it in the current operating cycle of the year. The next section of the balance sheet is called liabilities, and this is what your company owes. And we have current liabilities is one of the sections in the liability section, and this is paid in one operating cycle, paid within the year. And this would include accounts payable, this would include taxes, credit cards, lines of credit. I know that your credit card balances may not be paid off in a year, as well as the line of credit, but this is revolving credit, and really true to its nature, it's due on demand. So that's why we put it in current liabilities. The next section of the liabilities would be long-term liabilities. And these are liabilities are paid over a period greater than a year. These would be term loans, such as vehicle loan, truck loan, mortgages on a building, or capital leases to a new purchase of equipment. Then we have our equity section. This is the third section, probably the most misunderstood section of the financial statement, the balance sheet. And basically what the equity section is comprised of, if you are a corporation or a partnership, it would be comprised of your stock that you have to purchase to capitalize your business, and your partners an equity for each partner. It would also be in your equity section is any distributions or contributions above and beyond the common stock or equity capitalization that the owner or the shareholder or the partners would draw or contribute. And this would actually, this section would include, you can see I have owner, and that would be a sole proprietor. Then we have our retained earnings, and the question that I always get is, what is retained earnings? And my answer to you on that is, it is earnings that are retained. So and this can be expressed in a positive or negative number. We want a positive number, okay? A negative number can actually mean that we have an unhealthy business, and we'll talk about that here in a second. If we have a positive number, this means that the company has a history of profitable years and it has not distributed all its profits to its owners or shareholders or partners. If we have a negative number, this can mean a couple of things. We're a startup, and we haven't hit that point of turning a profit, or we have a history of lost years, or we actually have been profitable, but we have distributed out we've over-distributed the profits, meaning we've given the shareholders or the partners more than we actually had in profits, causing a negative retained earnings. And once again, net income is actually a part of retained earnings. So I talked about how the profit and loss closes at 12/31 if you're a calendar year, and we have the bottom line called net income, which we discussed. That actually gets closed into retained earnings. So what I want to do here is I want to give you a visual of what the balance sheet looks like. So here we have our assets. These are our current assets and our fixed assets. And the balance sheet goes from most liquid to the least liquid when we're looking at our assets section, cash being the most liquid, AR being the second liquid, inventory being, again, after AR, the next liquid asset. Then we have our fixed assets. These obviously aren't as liquid as our cash or AR. Then we move down, we get our total asset calculation, and then we move down into our liability section. And we have our current liabilities and our long-term liabilities. Once again, here's our accounts payable, our credit cards, our taxes that are due. I wanted to actually talk about this, but I don't think we'll have enough time. And then we have sales tax payable here. And those are all due in the current period. And just to touch on this, I always call, when I see a negative in a positive world, it means that there's been some posting error. There are a couple of things called contra accounts that we have on our balance sheet, and that's accumulated depreciation, which is negative, and this is what we call a contra account, and this is correct. And depreciation basically is a way that we get to write off the assets that we've purchased. So when we do purchase a major, let's just say a major piece of equipment for $100,000, let's just say, we're not going to go and expense that off in the year that we've purchased it, because it would wreak havoc to our income, our net income, and our bottom line. But what we do is we look at the useful life of that particular purchase, and then we depreciate it or amortize it over a period of time, and then we get to expense this portion out over a period of time on our profit and loss, and it comes up here as a negative to actually reduce the basis, the cost of our original purchase price. So that's a contra account. Unlike this, which is just a misposting, and there's no contra account, and I just wanted to show that if you see a lot of this on your balance sheet, you probably aren't posting correctly. So then we go moving down here, we have our long-term liabilities. These are notes that are actually due in a period of greater than a year, and then we have our equity section. We can see here, here's our owner's draw, here's our retained earnings, and then here is our net income, and this gives us total equity. And then we have our total liabilities and equity. And this is shown, this net income is shown on the profit and loss as well. If we were going to run a profit and loss for this time period, this would be the net income that would show on our profit and loss. So the calculation for the balance sheet is basically equity equals assets minus liabilities, and it represents the amount of money the company owes the owners after all the liabilities are paid. It's basically what you have left over. And if you think about a house, and especially in this market that's really talked about how we're upside down, that means that we owe more than we have, or what we own. So if we took the cost of your home and we subtracted what you owe, so we own our home, we owe on our home, and then what's the difference is what we have, negative or positive. Once again, we mentioned this before, the profit and loss helps manage sales and expenses, but you can't manage your company just from analyzing the balance sheet. Just from analyzing profit. So we're going to talk about the balance sheet and the wonderful information that you actually can obtain from the balance sheet. And that would include liquidity, AR collection, inventory health, and debt service coverage. And we're going to talk about ratios that you could run on using your balance sheet to determine the health of your business and help manage it better and make hopefully some nice changes. So here we have the first ratio. It's called the quick ratio. And this ratio actually measures liquidity. And this ratio actually reveals the ability of a company to pay its current obligation. And we actually, after we run the calculation, we actually want this ratio to be 1 or higher. And this means that the current assets can pay the current liabilities, meaning we have the ability to cover our current obligation. So let's actually look at a visual of this. So you can see here on the right-hand side, the quick ratio. I have A plus B plus C divided by D, E, and F. So A, B, and C is basically my liquid assets, my cash, my receivables, and my current assets. My total A, B, and C equal $254,000 and change, okay? So now I have to divide that by D, E, and F. So if I cruise on down, I have my current liabilities. Accounts payable, my credit cards, and my taxes, and my current portion due on long-term debt. You don't have, a lot of people don't do this, but actually it is a current obligation. The amount that you owe on your debt for this current cycle actually is a current liability and should be considered in this calculation. So our total current liabilities for this period is $20,659. So the quick ratio is basically our current assets divided by our current liabilities. And if I run this calculation, I actually get a ratio of 12.31, which is much higher than the one that we're looking for. So what does this mean? This means that this company, current assets, can cover its liabilities 12.31 times. Or for every dollar owed, the company has $12.31. So this is a very healthy company, and as I said, you want greater than 1. But you don't want that much greater than 1. And what I mean by that is that if we are very, very heavy in the cash, we may not be investing our money, our cash wisely, and we could be using that resource in some other way to get a return on our investment. Now, what happens if you run the ratio and you get a negative, less than 1, a negative number? That means basically that you do not have the cash in-house to cover your current obligations. The other thing that I want to talk about is if going back to the number is higher than 1, we actually have to then go into the next layer of analyzing this ratio, because what happens if our accounts receivable is really strong, as it was in this quick ratio, but we're not getting paid? So it actually gives us a false sense that we have the ability to cover our current obligations. And let's take a look at accounts receivable health. And accounts receivable should be monitored regularly in your business. If you get past 60 days, most likely you're going to have an issue getting collection. You don't want it to get past 60 days, especially if you're in the process of wanting to disengage a client. You want to make sure that they stay current. So let's talk about how we keep our accounts receivable healthy and how we can monitor the turnover on our AR to make sure we're getting paid adequately enough for our type of business. So there's two ratios that we actually use, and one is called the AR turnover ratio, which is down here, and this is sales for the period divided by average receivables. So in the next ratio, we can turn this into days outstanding, and we would take this average receivables, and we would take 365 days, 365, and we would divide it by this receivable turnover that we get from this calculation. And here is actually a visual of the accounts receivable health. So here, I take the calculation, and I have my average AR, which is my beginning AR and my ending AR divided by 2. And in this case, I'm using year end of the prior year and year end of this year. That's my period that I'm covering. I'm going to add these two. Once again, I ran this from QuickBooks, and you can modify your report and have this have both of the prior year shown on your balance sheet to compare. And I get a calculation. After I calculate, I get an average of $72,447 in average AR. I have sales, so I have to take my sales. I have to go over to my profit and loss, grab my sales number for this period, and I divide it by my average AR, and I get 2.79. So basically, this company turns over their accounts receivable at 2.79 times. Or if I want to convert this to days, taking the 365 and dividing it by my turnover, this company basically takes 131 days, almost 4 months to turn over their AR. Now, this could be really great if you're selling Lamborghinis or high ticket and you just don't sell a lot. So maybe, yes, your turnover is very high. But if you're a doctor's office, a lawyer's office, an office like myself, or any type of business that does not sell high-ticket items, this turnover would not be acceptable, and we'd actually have cash flow problems. So let's actually now move on and look at, we already talked about this one, let's look at a healthy AR example. So using the example of using the calculation beginning AR plus ending AR divided by 2, we have $3,583 as our beginning and $9,650 as our ending, and we divide that by 2. We get average AR of $13,233. Then we actually take our turnover. We calculate our turnover, and we take our sales from our profit and loss of the period we're covering or analyzing, and our sales were 202 and change divided by our average AR, and we get 15.3 times, much better than the 2.89 that we just saw. So this company turned its AR over 15.3 times, and if we calculate that out to the days, 365 divided by 15.3, we're actually, days outstanding in our AR is 23.85, and if we're offering terms of 30 days, we have awesome payers. Those are the types of clients we want to have. So what do you do to get paid quicker and increase cash flow and have a good AR turnover? Well, analyze the client and ask lots of questions. So this is easy in my profession because people come to me and I am going to discuss their financial ability and their capacity to pay their bills. And if I don't get a great feeling in my stomach, I'm going to get paid ahead of time, or I'm going to ask for a nice healthy retainer, which you should also do. Don't offer terms to slow payers. So if you find that you have slow payers, don't offer the same terms. Shorten up their terms. Push credit cards if that is something that would work for your type of business. Progress bill. So basically, if I have a progress billing, I would ask for a 25% deposit up front, and then every time I was 25% complete, I'd ask to do another billing for 25%. So when I'm at 75% complete, I'm actually 100% paid. And once again, monitor and don't let AR get past 60 days. Now, we can do the same thing for inventory. We can actually measure inventory to see how quickly inventory turns over. And poor inventory management can cause a cash flow problem. And actually, cash tied up in inventory that does not turn over can be a buzzkill. It actually can be the reason why business goes under. And we'll take a look at the ratio here and how this ratio works and how you would measure average inventory, how you would measure inventory turnover in your business if you're holding inventory. So once again, we would start with our average inventory, beginning and ending. I'm going to go to a visual here. I have my beginning inventory and my ending inventory divided by 2. I go to my profit and loss. I get my cost of goods sold, and I divide it by average inventory. And this tells me that my inventory turns over 23.98 times. So this is very industry driven. So if I am a produce, own a produce store, turning over my inventory 23.98 times would not be good. I would have a lot of spoilage. I would go under. I would actually have to have a turnover of probably 1 to 2 or 3 days. 3 days probably the most. Now, if this is a typical office such as myself, a doctor's office, any type of professional office, I wouldn't be having inventory. But if I got a little confused there. So if I have a retail store and I'm having inventory of 23.98 times, that might actually be pretty good for me. And I can look at my cash flow, and if turning over my inventory 24 times every 24 days, that actually they turn their inventory over 15.22 days, excuse me. So we turn it over 23.98 times a year, I'm so sorry. 23.98 times a year, and then we actually take the calculation, the 23.98, we divide 365 by our turnover, and we actually turn our inventory over 15.22 days. And as I said, if this was a produce store, this wouldn't be good. But if this was a retail store, this would probably be quite excellent. And this would be something that you would want to go out and benchmark and find out what your industry standard does. And that would help you gauge your inventory turnover. And also, this would have definitely does have an impact on your cash flow. So another calculation that you can run, another ratio, is return on assets, ROA. And this calculation basically is net profit, which you would get from your profit and loss divided by your average assets. So if we look at our visual here, we have average assets of $13,750. I'm sorry, I know the font's small here. And our net profit is $33,628. And if I go down to the bottom of my profit and my balance sheet, I can see here I can get the number right off my balance sheet for my profit, my net income. And then basically what I find out here is I get after I do my calculation, I end up with a number of 2.44. And what does this mean? So if I have a calculation, I end up going with, I have 2.44. That means for every dollar invested in equipment, the company has a return of $2.44. So I have equipment, and it's actually turning a profit for me of $2.44 for every dollar that I have invested, and that's pretty good. Now, if the ROA starts to decline, that is not a good sign. So you would want to run this calculation if you are having machine shop where you're using machinery, a manufacturer. You may want to use this if you are in construction and your equipment is basically heavily used in the construction part of it. If you were, I'll go back to farming, if I was actually owned heavy equipment and I went and harvested people's crops, those harvesters actually cost about $300,000 or $400,000. So I want to definitely measure my ROA to make sure that I'm using my assets efficiently and effectively. And if my ROA stays steady, that means that I am getting a return on the investments in the equipment that I've purchased for my business. Now, how else can we use this? This ratio is if we were actually planning on investing in another piece of equipment, we could actually analyze the return that we would want on that piece of equipment to make sure that it wouldn't put a decline on our ROA. So we want to monitor this, and this is a really good example of a decline of an ROA. Heavy construction client, heavy equipment. We all know the construction took a hit. So what happened if we measured the ROA, we would realize that the ROA actually may be negative. And what I mean by that is that there's actually no return on the equipment. We got equipment idle sitting in the storage yard in the yard. It's not being utilized, but we have to pay. We're paying property taxes on it. We are actually, having to use the space that we have. So we may have a problem there as far as paying for rental storage that we don't need. So if I look at the ROA at this particular time when construction was declining and the company wasn't using their assets, we would then have the conversation that your ROA is negative and it's declining. We now need to liquidate some of that equipment and get it off your books and sell it to get your ROA back to where it's healthy and we're actually returning a profit on the equipment that we actually still have in-house. So once again, it can be used to determine an equipment investment to make sure that it's a good decision and what you would need to get what return you would need to get on that piece of equipment to justify the spending. And if it's declining, we want to take a look at, do we have too many vehicles? Is the building that we own, not rent, is the building that we own too large? We're not maximizing the capacity. Do we have too many fancy computers, too much fancy technology? So that's what we want to look at when we're analyzing the ROA. Now, our last ratio that we're going to talk about is debt to equity. You all should probably be familiar. This is one that's very heavily used by banks, as well as the quick ratio that we discussed before. And the debt to equity indicates what portion of equity and debt the company is using to finance its assets. So we have long-term liabilities divided by total equity. So let's take a visual of this here. So we have total equity here of $175,000, $572, and we have total liabilities of $20,213. So if I go back to my calculation here on my PowerPoint, I end up, after I do the calculation, I end up with a number of 0.089, basically saying that I have debt to equity of 8%. And the result of dividing this debt to equity, the percentage of the company, this reveals the percentage of the company that is leveraged or indebted. So only 8% of my assets are owned by someone else. Now, the bank's threshold of acceptance is 30%, meaning if you have a debt to equity and that's saying that 30% of your company or your assets are leveraged up to 30%. Now, 40 to 50%, that means the company is in trouble. That basically means that, hey, our company is very leveraged. The shareholders or the owners don't own it. It's actually owned by another. It's basically based off of debt, and our debtors actually would own it. But we have to look at this in two ways. One, it can be a bad thing. If we have too much debt, we actually have to pay cash for the debt service, and this could definitely be a demise for a company because they did not invest in their assets wisely, and the debt service that underlies those assets aren't being used to the fullest capacity, or we misjudged our business and we invested heavily in equipment that was that's mortgaged. But there could be a good thing about this, because if we are using debt to actually increase operations by investing wisely in equipment, then the company actually has potential to generate more earnings that it would have not if it did not do financing. So the debt to equity, it could be a bad thing, but it needs to be analyzed if you are going to be taking on new debt and making investments in equipment. So, and that would also go with the ROA. So we're going to move on to cash flow. Now, cash flow is probably one of the largest areas that I get asked to help a client with, especially with closely held businesses. And cash management cannot be managed just by the balance sheet of the profit and loss. Actually, cash flow actually has its own report, because the statement of cash flow is very difficult to understand. So on that note, I'm going to actually give you an alternative to the statement of cash flow and show you how to manage cash with a simple Excel spreadsheet. I'm going to give you the visual here. So this is an Excel spreadsheet, and it's for the period of October to December. And I want to project my cash out from October, November, and December, and I want to see what my cash position is going to be at the end of December. So basically what I'm going to start here is, what is my balance sheet say at 9/30? What is the cash that I have in my bank at 9:30, what is on my register. And on this case, I'm going to use 9:30, and the amount of that, I have cash as of 9:30 of $36,000. So that's my starting cash point for this particular month of October. I'm expecting cash receipts of $17,895 for the month of October, giving me total cash to pay off my bills, cash bills, of $53,966. So that's the cash that I have to pay off my current obligations for the month of October. This section is basically cash requirements that I do not run through accounts payable. I'm going to actually cut straight checks for. I'm going to use my debit card. Maybe it's auto-drafted. So I have my merchant fees, which are auto-drafted. I have my fuel costs, which I pay on my debit card. My rent is auto-drafted. My cell phone's auto-drafted. Payroll and burden, that's going to be direct deposit. I have subcontractors and equipment rentals that I just cut straight checks for. So this basically tells me that I have $10,000 in those kinds of cash requirements for the month of October. After I pay these off, I have cash left over to pay off my accounts payable of $43,941. So now I have to pay down my accounts payable, or my accounts that I have terms with. So if I go through this, I actually have $99,636 in AP that I need to pay down for the month of October. This gives me cash available to pay down my credit and my debt, because I still have to pay my credit card payments, I still got my loan payments, and I still got a line of credit I got to pay on monthly. So that's going to cost me $4,000 in cash. It has a cash requirement of $4,050. After I pay that, I have cash available for distributions of $30,255. I take a distribution of $2,500 the month of October, giving me ending cash balance of $27,755. So that's what I'm projecting out that the end of October will look for me, based off of the cash requirements that I know that are coming up for the month of October. This number then gets moved up to here, because that's going to be my register balance, and my projected register balance as of 10/31. So I go through the same exact process for November, and I end up coming up with an ending cash balance of $31,326. Just like with October going to November, November 30th will go up to December here. This is my cash on hand as of December 1st. I'm going to expect cash receipts of $21,895. I'm going to go through the process of what do I have. That's going to automatically, or I'm going to cut straight checks or payroll. And here I have an increase in payroll because it's Christmas. I'm going to give bonuses to my employees. And this gives me cash available for AP. I'm going to go through once again and pay down my accounts payable, my accounts that I have terms with. This gives me once again my cash available for credit and debt. And then I have to pay my debt service. Then I have cash available for distributions of $29,846. So it's Christmas time, and I'm going to give myself a little distribution, a bonus of $7,500. Plus, I need to make a tax payment of $15,000. So now my cash actually is starting to dwindle, and I have $7,346 left. The reason why a cash flow projection is really awesome is if you are a trend business like my business, where I am very busy during tax season, and I make most of my money the first 4 months of the year, and then I take a nice month off in July, and then I slow down towards the end of the year. But my biggest expenses come at the end of the year. I have to fund my pension plan. I have insurance. I have all my software that comes due on 2012. I have Christmas bonuses. I got client appreciation. I have a lot of expenses towards the end of the year, but most of my cash is in the beginning of the year. So if I do a cash flow projection for 12 months, and this also would work if you were doing a budget on a cash basis, I can actually see that how much money that I'm going to would have at the end of the year, and if I have any requirement at that point in time to have to use any form of credit, if I need to leverage, and I need to use a line of credit, or if I need a credit card to actually help fund the end of my year, and then obviously then I can pay it off when my income increases at the beginning of the year. So that's what a cash flow projection would help you with, to help you determine when your cash may go negative and you need an infusion, or when you're going to have a lot of cash coming in and you need to put some aside for expenses that will come at a later time. And if you want this spreadsheet, you can email it and email me, and I'll be more than happy to send this spreadsheet over to you. So the next section the last part of this webinar is we're still going to talk about cash flow, but this is the question that I get the most. And it's always, why do I have profit on my profit and loss report but no cash? And then it gets followed with, I made how much money? I did not make that much money. Where did it all go? So when I get posed that question, the first place that I go is not the profit and loss, because obviously I know the guy or the gal has profit, but I'm going to go to the balance sheet, because the balance sheet is going to tell me the little story of where the cash has disappeared to or has been utilized or invested. Once again, the cash flow statement would also provide this information, but it's not for the novice user. But if any of you would like a little explanation of that, you can email me, and I don't mind spending 5 minutes to go over the report with you. So here, when I'm having this conversation with Larry, and he's telling me he has no cash, doesn't know where it is, he had great sales, whatever, I start to look at this. And this is my balance sheet, once again, comparing this year to last year, and this is my change from the year. And I can see that over the period of the year, he has a decline in cash of over $200,000. So I'm like, Larry, where did all your cash go? So I have to start analyzing the balance sheet to start to figure out where is the cash. Well, I can see here that we have an increase in accounts receivable. Right here on the right-hand side. My beginning for the period was $3,500. My ending is $141. And if I ran the AR turnover that we discussed before, I find out that Larry is only getting paid his AR is only turning over every 4 months. And I'm going to say, Larry, well, all your cash is tied up in your accounts receivable. You have poor AR management skills, and we need to look at how we can get you to get paid faster. So you do have cash in the bank. So that would definitely be something that I would notice on his account. Now, he may not know that he has bad AR, and believe me, I work with many owners that don't have no clue over the fact that they have bad AR. As an owner, you are responsible for knowing that what's going on with your accounts receivable. And so then the next section of the balance sheet that I would actually go down to is the inventory. And I would say, okay, inventory at the beginning of this period was 2,164, and now we're at inventory of 37. So I'd have a discussion with Larry, and I'd say, okay, Larry, tell me why your inventory is up. Did you buy some pink flamingos that just did not sell? Or is this because you have a job? We have fertilizing in January. I don't know when you fertilize, but we have heavy fertilizing in January, February, March, and you bought a huge amount of fertilizers for the next few months. So we'd have this conversation. Now, I'd run the inventory asset turnover, and I'd realize Larry's inventory turns over pretty nicely for his industry, and we're happy with the way his inventory turns over, and this isn't the problem of where his cash has gone. I know one problem is his accounts receivable. So then I cruise on down to the balance sheet, and I see that Larry bought equipment with cash for $10,000. He did not leverage. He did not get into debt. He just decided he was going to buy a new tractor for $10,000 and pay cash for it. So obviously that would deplete cash. So we have a $10,000 depletion of cash there. And then we have to look at debt service. And once again, debt service, if you have heavy debt service, this definitely could be detrimental to your cash in the bank, especially if we're not in the debt that the investments that are backing this debt were not wise. And I will explain what I mean by that. A very expensive vehicle. That very expensive vehicle that you are going to buy is not going to add a penny to your bottom line. Now, that equipment that you're investing in will possibly have the ability to add money to the bottom line, and that's when we would run the ROA, the return on asset calculation, and we would also run the debt to equity to make sure that it is a wise decision for you. So I would look at this, and I can see that Larry here has made wise decisions utilizing his debt, and that he's not debt heavy, and his cash is a lot of cash is required to pay debt. Then I would cruise on down to the last portion of the balance sheet, and I notice here I have a $55,000 draw with Larry. I say, hey Larry, I see that you took a $55,000 draw, and that is really where your cash is gone. So he's going to say to me, yeah, but it's only $55,000 and blah, 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 and I'm going to say it's still a hit for cash, and it definitely is a depletion on cash. So there we've solved the problem and demystified Larry's question of where is all my cash. I had a great year. And we can go through the balance sheet comparing periods to say, okay, this is where the cash is gone. So anyway, this actually concludes our webinar. We're going to move into the Q&A portion of the webinar. And thanks for joining, and free your inner accountant. Everybody has an inner accountant in there somewhere. So free it and let it be. And once again, if you want to email me or visit my website, here's the information. And I hope you all have a great day. Thank you. Okay, I don't see that anybody's posted any questions here. I'm actually going to unmute, if I can figure out how to do that, unmute the phone. Button. Well, I'm really sorry. I can't figure out where the unmute button is. So, see if anybody, I see that Tracy's here. So thank you, Tracy. Hi to you, too. Let's see here. So this is one question. How often should I review my financial statements? Well, that really depends, but at least a minimal of monthly. You should be reviewing your financial statements monthly and learning, because if you're actually only reviewing them once a year, it's really hard to measure at that point in time what your business is doing, and if you're actually using it to measure your goals and your sales goals. If you're only analyzing it once a year, it would be really hard for you then to maintain the goals that you're looking at. Plus, you want to maintain financial information and use that as a knowledgeable tool to help you move forward with your business. So monthly at least. Okay, so based on the fact that the P&L covers a period of time, is the same thing as, yes, the P&L is the same thing as an income statement. Exactly, exactly, exactly. I'm sorry if I did not make that clear. Will these slides be available? Yes, I will make these slides available. So anyway, I want to thank everybody for showing up, and have a great day. And once again, you can email me after the webinar, and email me after the webinar and let me know if you have any questions. Okay? Thanks so much, everybody.